Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing, from foundational concepts to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Shum, head of investor relations here at Focus Capital.
I'm Chad Schuler, founder of Focus Capital.
Chad, it's been a few episodes, but a few episodes we talked about GP-LP alignment and how the structure of a deal determines whether your operator's incentives are working for you as an investor or if they're working around you. Today, we're going to get pretty specific about one of those important pieces of the conversation. So fees. Acquisition fees, asset management fees, and disposition fees are three terms passive investors will encounter in almost every deal they review, no matter who the operator is. Yep. And understanding what they are, how they're calculated, and what's reasonable versus what's excessive is one of the clearest ways to evaluate an operator's alignment with their investors. So let's start really broad. Why do fees exist in the first place? Like, before we break down individual fees, why do sponsors charge fees at all?
Yeah, really. I mean, the fees are up front, pay along the way and up front as well to help them support their business overhead. And most sponsors don't make a lot of cash flow or money in the early years from an investment. So some that's going to pay for the team. But the team is going to find the properties, to manage them, manage the investors. And if you don't have that and you can't support the team, well, your investment may not go very well.
Yeah, and I think that operating real estate is often not seen as a business from a firm perspective, but we have very real overhead costs, just like any other business. We have paper costs, we have rent and stuff due in our offices. We have payroll that we need to make, not just from an asset management perspective, but we have assistants and analysts and stuff like that. And I think that people only see the investing side and operating an investment, and they don't see like the quote boring or administrative side. So a lot of that goes towards those things. I think fees exist to compensate the operator for that work, and then obviously performative kind of things come a little bit later.
Yeah.
So the three fees that I would kind of like to dig into today, there's all types of fees, and we can get into that slightly later in the episode. But what I want to focus most of our time on are acquisition, asset management, and disposition fees. So at the very beginning, what is an acquisition fee?
Yeah, that fee is really the fee that a GP or sponsor is paid when they go acquire the deal. And typically is a percentage of the purchase price of the investment of the property.
Yeah. And is that a one-time thing? Or yeah. So where investors should pay attention, for anyone that's listening, for an acquisition fees, they're earned at closing regardless of how the deal ultimately performs. And so this is something that you should pay attention to depending on what that percentage of the acquisition is, because I think that you had mentioned in an earlier episode that like being compensated all at the back end or all on the front end, those are both red flags for different reasons. Yep. And so making sure that there is a balance, that it is appropriate to get compensated up front for the acquisition, not just for the work that went into the acquisition, but then also to sustain some of those business expenses that we had talked about up front.
Yep.
And that's why I think that they need to be evaluated in the context of the full fee and promote structure. An operator that's charging a high acquisition fee with a modest promote may be more focused on deal volume than deal performance.
Yep.
But then also on the other side, you don't want to be super encouraged or motivated to just keep selling on a short cycle. Asset management fee. What's an asset management fee? Why do we charge that? What goes into that?
Yeah, asset management, I think, is one of the, they're all important fees, right? This is very important because without asset management, your investment is not going to perform the right way. So that's usually a percentage of the effective gross income, or EGI, that the property produces, the total revenue, right? Maybe it's 2% or whatnot, but that's the, usually paid monthly or quarterly to the sponsor, ongoing throughout the life of the investment hold cycle.
And so does this fee always compensate the GP, or do they ever contract out asset management, or is that how does it differ between property management fees that somebody might see versus asset management fees?
Yeah, great question. So this should both be in the deck as well, right? So the property management fee, that is what's paid to the property management company, whether it's a third party or internal vertical, that is paid to cover those property management companies' cost to manage day-to-day, week-to-week, boots on the ground, right? Mm-hmm. In every investment, the best way to do this, to manage it, is to have both property management and asset management. They're both different. They both exist for different reasons, but they're both important to not only provide high-level asset management oversight, but also the day-to-day operations with the property management company. So both are needed. Asset management, back to your first question, that should be in-house, right? If you're going to invest with a sponsor, you'd hope they have internal people on their team do asset management. But there are sponsors, I know many personally, that they outsource that to other people. And yes, you can do that, right? But you're going to pay the sponsor the asset management fee, and their job is to asset management, whether it's with their own people or other outsourced people.
Yeah, and I think that investors should understand whether they're paying for 2 layers of oversight or whether it's justified from an operational structure. So like you said, asset management and property management, when it's done properly, are 2 different sides.
Yeah, you got to have both.
Exactly. And so if somebody sees, 1.5% of EGI, asset management fee, or 2% of X asset management fee, and then they see an additional 3% somewhere else, the operator, as long as you're very clear on how they're structuring themselves operationally, is not double dipping there. And that can also be a question that people come up. And so when you're looking at fee structure, realize that it's very common for there to be 2 levels of quote unquote management fees. But just because we conflate asset and property under the same kind of nomenclature, it doesn't mean that they are fulfilling the same role.
I think it's important to dive a minute deeper on that subject, because some people, even myself a few years ago, didn't understand the difference on what the role was in both those management parties, right? Mm-hmm. Property management is just the day-to-day operations, the leasing, the maintenance, the execution, and really property management companies, they want to keep it full and keep rents low and keep it easy. That's what they want to do, right? Well, asset management, they're there to drive the business plan, drive the value. So they have to think much more high level on how can we grow this property's value, either through pushing the PM company, creating some creative ways to push revenue, other income strategies, expense reduction strategies, tax appeals, insurance strategies there. That's all stuff with asset management. The PM companies don't do that at all. That's not their job at all. So, and asset management too is you're managing the overall cash flow of the business for your investors, and when to sell, when to refi. That's all much higher level activities.
Yeah. And one thing that I think is worth mentioning for investors is that there are a few nuances. You had mentioned how those fees are calculated. Some sponsors calculate off a percentage of revenue, while others might calculate it off a percentage of equity. Yep. And that calculation really matters, because a percentage of equity on a large deal can produce a significantly higher fee than a percentage of revenue. So investors should always understand where the denominator is coming from when those fees are being calculated.
Yeah, that's true. And if I'm an investor, I prefer for it to be on the revenue, because you're in creative alignments of incentives.
Yep.
You're incentivizing the asset management firm, the sponsor, to grow the revenue, which grows the cash flow for the investors.
Yeah. And so you can't just be like, oh, they have a 2%, asset management fee. 2% of what? Like is an additional important question to ask. The third fee that I wanted to talk about, and this is kind of going and following along the life cycle of any of our full cycle deals, acquisition fee happens at acquiring. Once we're operating a property, we are actively managing an asset, so there's an asset management fee. Okay, what is a disposition fee?
Yeah, that's simple as it says, right? It's just a fee when you sell a property. The GP or sponsor is paid usually a percentage of the selling price of the asset paid to the sponsor. It's a one-time fee.
And I think that something that is important for everyone to understand is that this is not just a compensation thing. This is the way that GPs are made whole from managing the exit process and making sure it goes as smoothly as possible, and obviously benefits their investors. Like, selling is not just selling. You have to engage brokers, negotiate the sale, coordinate DD or due diligence on the buyer side, and then you also have to close the transaction. There's a lot of other work outside of what we did to manage the asset that's additional, and that's where that disposition fee is justified.
Yeah, and I would say it's similar to, maybe an example I would give is of a development project. Development project, the developer fee is normally not paid all up front when you close on a loan. It's paid maybe a third at loan signing, maybe a third at certificate of occupancy, and a third one is stabilized, right? It's spread out. Same with this. Like, if you look at all the fees, the fee on acquisition, the asset management fee, the disposition fee, that really is the sum of the operator GP's compensation along the 5-year to 7-year period of time, right? Well, you're going to spread it out. We're going to give some up front to keep the lights on and employ the best team they can. You're going to give them some every month along the way to manage it and grow the revenue, hopefully. And so at the very, very end, once they finish the job.
Yeah. And then I also think that it's important for people to know that like some operating agreements allow a GP to take a disposition fee in addition to a brokerage commission. So if they're acting as the selling broker. So investors should also understand whether this dual compensation is disclosed and reasonable given the services provided.
Yeah, that's fair.
Now that we've talked about 3 specific fees, we even mentioned other fees, property management fees, and stuff like that. How should investors evaluate a total fee load of a deal? So if they're looking at all these fees in isolation, how should they actually think of them around the cumulative like fee picture?
Yeah. And there's obviously going to be the promote or the carried interest right at the very end, which is really the big reason why sponsors do this. They don't do this for the small fees. They do this for that promote, which they hope to get on the sale. But I would say you have to look at what's the ratio of these fees added up relative to the overall potential comp of the sponsor, including the carried interest. Then maybe it's a third or a fourth of the overall comp. I think red flags for me would be when it's well over half or 3/4 of total comp, or the promote is very, very skinny and they're relying so heavily on these upfront fees, which is most of their comp. So it's all about incentives, right? You want to have everyone aligned to where they're going to be there to get the job done for the next 5 years and do a good job.
Yeah, I think before we dig into red flags, which will be my next question, if someone is modeling stuff out, I think a useful exercise is to kind of aggregate and total the fees paid to the GP over the life of a deal. And you can do that very simply back of the napkin or even in your own spreadsheet. So you got to consider the acquisition fee at closing, asset management fees annually, the disposition fee at exit. Most operators will tell you how long that hold is. So you can be like, okay, if they're projecting this revenue for over 5 years, here's the exit. You can kind of come up with the back of the napkin and then compare, like you said, compare that total to the projected promote. If fees represent a disproportionately large amount or large share of the GP's total compensation relative to the promote, then that's a signal worth examining. And it also probably suggests that the operator's primary incentive is transactional rather than performance driven.
Yeah.
Conversely, a structure where fees are maybe modest and the promote is meaningful and structured behind a meaningful preferred return, both for their investors and for themselves, that signals an operator who is betting on their own execution. And that's how we structure our fees here.
Yeah.
You had mentioned red flags before. Let's say there's a practical framework and there's no big major red flags on like no one's charging, a 10% acquisition fee. That's a pretty obvious one. What's a reasonable fee structure and what should investors scrutinize? Where would people or maybe operators that are less transparent hide certain things, and where can investors look for those?
Yeah, I mean, you can bake them in the cost or just not disclose them, right? And it's either PPM, which opens you to a lot of legal issues, but the best sponsors that I've seen, what we do is we disclose them, right? Because you should be compensated. If someone says there's no fees at all, I'm gonna raise an eyebrow, like what's going on here? How are they getting compensated for the next 5 years? But yeah, we can go over like averages too if you'd like to on those fees.
Yeah, I think that for the 3 fees that we talked about, acquisition fee, that's usually on average between 1% and 2%. The asset management fee, again, around 1 or 2%. And then, but of revenue, not of equity. And then the disposition fee is usually around 1%. That's pretty standard across the board.
Yeah.
The promote is typically between 20 and 30% of profits above the preferred return.
Yep.
I would say is pretty standard, and should be the largest single component of GP compensation if the deal performs. I think when it comes to percentages, like you were mentioning, that are red flags, I would say acquisition fees above 3% is typically not standard. Again, I'm not going to say that it's a major red flag, but it's definitely something to scrutinize depending on how the deal is structured. Like I said before, asset management fees calculated on equity and not on revenue, because that doesn't mean that your incentives are aligned there. And then I would say disposition fees stacked on top of brokerage commissions taken by the same entity, there could be, it could definitely be justified, but it's worth and it merits a little bit more investigation there. I think the clearest signal, and this is a common theme across almost all of our episodes, is the clear signal of a well-aligned structure is the GP's best financial outcome requires the deal to perform well for investors. So if the GP can generate substantial income fees from alone, regardless of performance, then there are definitely some things that you need to look at.
Yeah, I agree with that.
Here's the big finale question. We talked about fees. We talked about red flags. We talked about deal structure and fee structure. How does Focused Capital specifically think about fees, and how do we approach our own fee structure?
We think about those to where, okay, what's going to be a good balance between the investor's best interest, being a fiduciary, and being the best investment manager we can, while also getting the appropriate compensation, some up front and some along the way, and then some at the very end. How I view these fees is I'm really working for the end, right? We sell someday at 5-7 years. We perform very, very well for our investors. We've all won together, and that's where the majority of our comp will come from. That's how I think about fees right now.
Yep. I think that as long as you keep your investors top of mind, like everything else, and like you said, how can we best serve our investors? We're not going to be able to best serve our investors if none of us are getting paid for the first 5 years of a deal. So that's why fees are justified. Now, obviously, we have to be within those averages and appropriateness, but we wouldn't be able to have the best team without operational capital and being able to fulfill the operational overhead.
Yeah. Really, for me, it's like I'm more focused on, well, how can we? The upfront fee is nice and all, but it's really like building up those sustainable monthly asset manager fees to where that really just creates a more sustainable business, and that then creates a more stable environment for the company, the sponsor, the GP, to employ great people. So they're all important, but the ongoing asset manager fees, we're incentivized to push the revenue, push property's value to increase those monthly.
That would be one of those win-win scenarios because we base our asset management fee off of revenue. If our fee is if the end number of our fee, the fee percentage doesn't change, but if our end number keeps going up, that is directly indicative of revenue increase, which means that we're doing a good job. Yeah. I think the final note that I would leave for investors is that we've talked about a lot about things to be cautious about, red flags, where to scrutinize fees. Top line fees are not the enemy. It's opacity. If a GP or an operator who clearly discloses their fee structure and can articulate rationale for each component and has structured their compensation to reward performance, that's telling you something important about how they operate. And then the ones who are obscure and non-transparent, stack or front load fees at the expense of the investor, that's also telling you something too, but on the converse side. Anything else that you'd want to add when it comes to fees, fee structure, or how firms like us consider fees?
No, I think we covered a lot here. It was good. I think it's the end of the day, the summary here is like sponsors need to get paid the fees in the appropriate manner that's fair for both sides.
Yep.
So they can manage the investment very, very well to make your investment go well.
Yeah, I agree. So in the next episode, we'll be covering Class A, B, and C properties, how the classification system works and what it means for risk and return, and then how experienced investors use it as a framework to ask better questions rather than just drawing quick conclusions. Something else that I wanted to add for anyone who's just listening and maybe not tuning in on our YouTube is as of today, we're officially on both Spotify and Apple podcasts. So you can digest and listen to, or look at us if you want to on all platforms, YouTube, Spotify, and Apple. So hope to see you guys on those platforms. Big shout out to one of our analysts, Ryan, who helped me out with that. And we're looking forward to seeing you on all platforms. Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.